What is going on, Future Focus team? Back at it with another video. If this is your first time to the channel, thank you. Welcome. If not, welcome back. The purpose of this channel is to educate and entertain you, but the ultimate goal is to make you a little bit smarter today in order for you to have a better tomorrow. With all that said, let's get into it. Today, like I told the members of the chat, we're doing something a little different. I came up with some visuals today, trying to make this a little more professional. This is a very important topic. And the reason it's important is because it's in investing, not just in the stock market, but investing in anything. And psychology plays a big part. Today, we're going to be discussing some of the stuff that a professor, he's a professor of behavioral science, and his name is Brett Steenbarger. And these are just some of the philosophies and things that he found. So some of the background behind it, he was hired by some brokerage firms that do like trading and all that. They manage big portfolios, like billion-dollar size portfolios. And the purpose behind it was the owners of these companies wanted to see if there was some traits that they could identify during the hiring process whenever they were trying to get new people to come trade for them, to see if there was like any tangible things that they could find that would make hiring somebody more effective. Because sometimes, you know, they hire people and they end up losing the company money. So they wanted to see if there was a way to reduce those losses. So what we're going to be talking about today just goes along the lines with that. So these are some of the variables in his study that he came up with, that it came up to like 3 big things. Today, we're going to concentrate more on the cognitive part, which is like the thinking portion, the actual psychology of it. But a lot of it came to like personality traits, you know, the way people behave, the way people act, nature versus nurture, things like that. And then biographical traits, just wherever a person came from, where they grew up, were they from the city, were they from the country, things like that. But today's main focus is going to be on the cognitive portion of this. So cognitive, it was broken down into different portions. So it was broken down into thinking fast, which is, as it says right there, rapid pattern recognition, or seeing things differently, quickly. And, you know, this is important, especially for anyone that's doing day traders. Like they got to be able to think on the spot, because if they miss out on a few seconds, like things change rapidly. So a few seconds to them could mean like, you know, hundreds of thousands of dollars, depending on how big of a portfolio they're managing. Thinking slow is more for someone like us, like all of us here. We're, you know, long-term investors. We're not trying to make a quick dollar and flip it. We're not day trading. We don't have time for that with our occupations. So thinking slow is more about, you know, deep thinking, research, and understanding things in more depth than average. So what goes along with this is actually putting some time into your craft. You know, just like a mechanic doesn't just go and try to change oil without, you know, at least YouTubing it to see how it's done, or reading about it to see how it's done. One thing he came up with was that none of the traders that he like interviewed or they did the study on had 100% of both of these, thinking fast and thinking slow. Some had that were successful, either had one. I'm admitting Juan real quick. Welcome, Juan. So hold on. Diego, text me. What are you saying, Diego? Got it. He caught an error. I spelled psychology wrong. I'll push later, Diego. So thinking slow is like, again, something more for what we're doing. We're trying to understand things in more depth. And that's reading charts, things like that. Going and seeing a company's, their financial charts, you know, their quarter form, like every quarter they come out with paperwork of how they accomplished last quarter. So that's called their quarterly report. And directly after that, they'll release their quarterly statement, where they come out and they actually give their guidance for the next quarter. So if you're invested in a company, like, and you want to be a long-term investor, it's always good to listen in on these phone calls, on these conferences they have, and read their quarterly charts. It's a lot of paperwork. It's a lot of reading. And it's if you want to be really beneficial and you want to know in the company that like that you're actually trading, and it's good to go in there and do that. But again, the people that he identified didn't have both of these, like a really high thinking fast and a really high thinking slow. The ones that were successful were either really fast thinkers, or they thought really slowly and took their time, or they were like generally a 50-50 mix of both. But whichever one it was, they both required sustained attention. All right. So this is something that affects all of us. It has affected me. Maybe if one of you guys could chime in if it's affected you as well. But these are biases. So these these are three biases that we just naturally have within us, and we kind of have to fight them. The first one is confirmation bias. So how does this relate to what we do? So confirmation bias is basically looking for stuff that's going to back up what you originally thought. So for example, you think a company is going to do really well, and you end up looking for stuff or like searching for stuff that tells you what you already think, whether it's reality or not. Because no matter what you're looking for, you're going to find both opinions in the internet. So we end up kind of pushing towards whatever our original bias was before we even began. So that's known as confirmation bias. So recency bias is just because you've been successful lately, you think it's going to continue, and you automatically assume, and it connects with outcome bias. You already assume that the outcome is going to be the same every single time because that's what it's been. If you've been recently doing great, if a company's recently be doing great, you put a lot of money into it, or you go all in, as some people say, because you feel they're going to continue to be doing great. And this can really hurt you, because you end up seeing some information which is the confirmation bias. Let me use Starbucks as an example. Let's say you were invested in Starbucks and you had just 4 shares of Starbucks, and you were debating whether you should put more money in, and you were kind of on the fence, but you were more towards yes. And you tell yourself, you know what, they're doing great. Their stores in China are opening up. So, uh, I think I'm going to put more in. So I'm going to do some research and see if I should do that. And then you end up seeing where, the herd mentality, all the people on YouTube are like, buy Starbucks, buy Starbucks. You already were thinking that. And you're like, well, I was already thinking that, so I might as well buy it anyway. And next thing you know, some negative news comes out on Starbucks, just like it recently did, where they said they're going to push more towards not letting people into the store, like more outside the store delivery to people, which kind of messes up their business model. Because originally their business model was people come in, they use the Wi-Fi, it's kind of like a hangout spot, and people end up drinking a few cups of coffee there because they're there all day on their laptops doing work. It was kind of the ambiance of the whole thing that was part of the strongest part of their business model. And now by taking the cup, taking it outside to the customer, that's kind of defeating a huge part of their business model. So that's just something to keep a lookout to. These are biases that we all internally have. Does anybody here have any moment like this where they could share, where they felt, they were maybe fell into one of these?
Yeah, I'll chime in, sir. So when I started, I had initial goals, and my goal was to slowly make a profit, and then take those profits and use them to pay off 2 credit cards debt free. And back in about 3 weeks ago, I could have cashed in and been debt free, but because I thought I was doing so good, I just say, let me just write it out. Let's write it out. And then that stock eventually went down at least $4 grand. I'm still in the green, but I could have cashed out $4 grand positive. So the greed got to me, and I eventually slowly deviated from my goals. So this past Saturday, I was up to like 3 o'clock in the morning, and then it hit me. I'm like, you know what? I deviated from my goals so much that I'm losing track of what I want to, what my initial goal was to attain. and that was to get money, pay my debt, and get out debt free, and then revisit the market with money that I have access and just say it's what we call gambling money. And so, yeah, so for me, I'm going to stick to my goal, refocus, get out of debt. So I'm not in debt. And then the money access that I had that I would have paid for my credit cards on a monthly basis is now income that I can throw in the stock market and and just become smarter in what I invest from this point on.
All right. Thank you. Anybody else? All right. Let's move on. All right. So this was a different aspect. It's all connected to the cognitive portion, but it's about being original and creative. He found that the traders who were more original, more creative in the way they traded were more successful. So this is the problem. And it goes with the herd mentality that we spoke about. If you look at the same thing as other people, you'll tend to do the same thing as other people. And if you're doing the same thing as other people, you're going to have the same results as other people. So, I think that happened to me when I first started and I was looking for companies to find, and I found myself, on YouTube or on different blogs or whatever, and trying to see what other people were doing. And it didn't strike me that if I'm doing what other people are doing, I'm kind of late to the party already. And anytime you're late to the party to somewhere, I'm not saying you can't make gains, but your gains are not going to be as strong as they could have been if you were maybe looking at a different angle of another company while everybody was focusing on this particular company. If you were looking at, the financials of a different company, you may have been early to another opportunity, because that opportunity that you're about to jump onto, which everyone else already has jumped onto, that's not the last opportunity in the stock market. It never is. There will always be another opportunity. So while everyone's already on this opportunity and this is the hot trend, you should be trying to get away from a trend and start looking for the next opportunity. And that's how you'll make the most money. And I'm still conflicted with that sometimes. Somebody will mention a stock and then it'll get stuck in my head, and I keep thinking about it, and I spend a lot of time on that. And by then, who knows how many opportunities miss me because I was over here stuck on an idea that somebody else is like Inception. They put it in your head and like it starts to sprout. So the solution, look at things differently and look at different sources that you're normal. That's one thing I've done. I've gone to try to look at other different outlets besides just YouTube. A lot more reading. I feel like when I read, it kind of sticks in my head more, and just try to think outside the box. One of the examples that Dr. Brett Steenbarger had was one of the companies that he was at. They had this system where they could trace satellites, and the satellites would focus on the pier, and it would be able to see ships. It would be able to identify the ships, what type of ships they were, what those ships were bringing in. And all of this was a correlation to the economy in that area. So they used all these, this technology to their advantage, and it gave them an edge against their competitors just because they could predict different things that were going on just by this technology that they were using. And this was just, them thinking outside the box. That's the way I looked at it. All right. So the next thing he noticed was that people were more successful when they either learned from mentors or they worked in teams. So one of his big takeaways was that mentoring is the dominant path to success. So one thing he thought about was like the Olympics. There's no Olympian that he's ever seen or I've ever seen that's made it by themselves without somebody training them or showing them the way, or giving them different conduits to get to where they wanted to go. Just like chess in school, it's not like an individual sport. It's chess teams because they learn from each other, and by playing against each other, they give themselves more competitive edge because they see different outcomes, different ways that people think. So when they go to competitions, they kind of have they're set up more for success than if somebody were to just do it themselves. So that's one of the main reasons I created this whole, future focused team. It was to not do anything by myself. It was to, I'm humble enough where I could learn from somebody who's 17 years old or 18 years old. And I know I have a lot to offer where I could teach even somebody like Juan who's here, and he's way older than I am. Not to throw you under the bus, Juan, but but you know, he's here. He's being humble enough to, you know, maybe catch something here. He might already know this, but he's here willing to learn as well. And just as I'm willing to learn from the younger ones in the chat. And it's hard to learn the how to do something if you don't know anybody that's done it. And I know he has a friend of his that's been successful, and that's somebody he's, you know, is kind of his mentor right now. And that's kind of what we're trying to do here, you know, be there for each other. The master apprentice concept. Um, so this one's very big, and I'm gonna come to you guys for this one because I don't know. There was times where we were really down in March, so I want to see if you guys maybe have something for March where you guys were, you know, you had to be emotional resilient. So it doesn't mean erasing the memory of bad trades or bad stocks that you picked or big losses you had. It's about using those to learn from them and using them to guide you in the future to make better decisions. And you know, in the Marine Corps, we have something that says, know yourself and seek self-improvement. And that's basically what this falls down to. You know, see the mistakes that you've made, and not just the mistake you made, but what made you pick that stock that time. If you picked a stock that lost or went bankrupt or they went to zero, what made you pick that stock to begin with? You know, little things like that may help you in the future. And by doing that, it will help us traverse our learning curve and steepen our learning curve. So I'm gonna come to you guys and see if there's how you guys feel about this topic right here, about being emotionally resilient. Nobody? Cricket.
I mean, you know, if I'm in the ballpark, sure, I would say that like the bad trades that I had were like, you know, when I bought some of the stocks I got into are penny stocks, and I would say stay away from penny stocks, stay away from penny stocks. I've been lucky, and then I've also failed in some of the penny stocks where I didn't do my thorough research. I've had 3 stocks that I bought that thought they were going to be good, and all of a sudden, they got a reverse split. So if you guys don't know what a reverse split, I didn't. And then like one day I woke up and I'm like, oh shoot, because when they did a reverse split, they give you the price they're going to push it at, and you look like you make gains. And then when the stock market opens, your shares then drop to the reverse split. Let's say you had 100 shares and they do a 1 for 5. You're going to have 50 shares when the market opens at the price they give you. It's still going to be equal to what you had balanced before the reverse split, but you have less shares. And I learned the hard way 3 times with penny stocks. Luckily, I've been lucky with some of them and be successful. But again, when I saw that, you know, it's just like initially I was down like $2,000 when I started. That's how much in the red I was at $2,000 from when I started back in April of last year. Coming into the new year, January, I was down $2,000. But luckily that's changed for me. And yeah, it was just, yeah, I can just say emotionally, it was just, it was painful. I was like, man, I got in this to make money, but I'm $2,000 in the hole. You know, there was days I just wanted to sell everything and just get out of it and say, don't have to deal with it. But I'm glad I stuck with it. I've learned. But again, like I said earlier, I deviated from my goals and what I wanted to attain first. So now I'm refocusing back on attain those goals. Got 2 stocks that I'm looking at. Hopefully that by Monday and Tuesday this week, they get to a price where I'm comfortable and I'm going to sell. And then once I sell those, I'm going to come back and just start hitting the market a little bit smarter and better and a little bit wiser where I put my money at.
All right, thank you for that. What tends to happen sometimes is, you know, like right here, difficult for someone to be wrong 50% of the time. So sometimes people take losses hard and they could react either that they quit and they say, I'm done with this, and they stop, which I'm glad, Juan, you didn't do that. And other people, they do the opposite where they double the money they had and try to make all that money back. And they end up losing again, you know, because they're emotionally throwing money back. And I'm sure if any of you know gamblers, that's the same thing that happens to gamblers in Las Vegas. Like they take that one loss and now they're not just trying to go positive. They're trying to make their money back and go positive. So they're like doubling up. Then they lose that. They quadruple up. Then they lose that. And that's a whirlwind you don't want to be a part of. All right. So this was a very, go
I
ahead.
got some. So I think he brought up a great point when he said, um, obviously glad, like you said, that he didn't get out. But I think ultimately, no matter what, this game or anything else you do in life, with the failures that, those all roll into some form of lesson. So to his point, sticking with it and learning from what he did, even though it did take a few times, I think that's very key to like your progression as you're in this game, because it just shows you, and you're a little more reluctant, I guess, in a way, because you tend to do the research more. You tend to do what you didn't do, or what you did the last time. You're trying not to do it, so that's why you're taking those preventative measures in order to not get the same result.
Yeah, big facts.
I'll add
So
one more thing. Like I said, and I appreciate it, Diego. Yeah, everything you learn through your fails, it's a lesson learned. And like George said, that I got a good guy, a good friend, and he's been doing great. And one of his shares, he's like digged into it so much that he's made millions of dollars already up to par in the share and his fuel sales. And he's always giving advice to. He has this. He's part of the group. If you guys want, I'll send it to you. But you got to be careful. There's a lot of people in this group, and they post stuff. These guys are inexperienced. So when I think I invited some of you guys in it, and I just told you, hey, if you see anything from this guy's post, read what he says and follow what he says. But he's always so fuel sales last week went up to like 350. He sold like 80,000 shares because he made 300,000 positive profit. And what I didn't know, he put in there that he took a loan from his credit card, like 125,000, to buy more shares. So he took that money, paid off the credit card, still had an excess of 175,000. And then what the fuel sales went the next day, it dropped down to like 250. He went back and bought more stocks into that sale because he made almost $1 profit the day before. So then he took that money because he's in the gains, and he took it back and put it in that money. So he put out to everybody, hey, do not buy fuel cells unless it's $2.80 and below, because he already knows the average price and where you can make money from. So again, stuff like that. When I saw that, and then last week, like I said the other day, the shares fuel cell dropped down to like 250 and something. I bought another 100 shares, and it dropped down like 245. I bought another 100 shares. So again, I'm learning to, if your shares drop down, it's not going to hurt. If you buy more shares at a lower price, you're eventually going to even it out. And you're just looking for that big break. And like I said, and you got to understand the company. And like I said, my friend Alex, he's been investing in this company for a long time. And when he talks about it and he says, hey, they're going to do good, or hey, look out for the, hey, look out for the burst, it's about to happen. He's been right like 99% of the times. And people that follow him has made money off of him. So again, until he tells you otherwise, sell or don't do this. Actually, he saved me the other day, and I'm going to tell you, I bought a share in XPSA. He knew they were going to do a reverse split that same day, and he put it out there, hey, sell your share because I don't trust it. They're about to do a reverse split. As soon as I said that, that was the first time I bought a share that same day, and I sold it that same day. I made like 5 cents profit per share, like $30 altogether. But it's $30 profit, but I sold it. But again, and I'll be honest, like I said, what George is doing here for all of you, listen to him, man. I mean, tell you what, even though I started and then he invited me, I think I've learned more from him in the last few weeks and what he provides. So those for you junior Marines and you salt dogs here, listen to him, man. If he gives you his advice, I think he knows what he's talking about better than what I'm talking about sometimes. Be honest, like I said, the first time I joined it, I was gambling. I was rolling the dice, and but again, by doing that, I've also researched and learned quite a bit. But can I get better? Yes. Can we all get better? Yes. But we got to, like I say, we have to be humble to say, teach me. I want to learn today.
Thank, thank you for that. And this goes along exactly what you were just talking about. So when you is having attention to detail, you have to give yourself a risk and reward for every single, whether it's a house you want to buy or a stock you want to buy. What's the risk? How much of my money and capital am I willing to risk on this investment? Is the reward that I could potentially make worth what I'm putting in? Am I going to put in $20,000 into a stock that I feel may just go up 35 cents? Is it worth it to do a risk that big? So this is what kind of what he was talking about, what Alex does. It sounds like this exactly. Where do I buy and where do I sell? And you do this by one, if you're investing in a company a long time, you see it. But if not, every single company has their history online. It's public knowledge. So you could go back and study the charts and see, where have they been profitable? When have they not been profitable? See how many quarters in a row they've been profitable. If they pay dividends, how long have they been paying them? Have the dividends gone up? Have the dividends ever dropped? Things like that. And always be prepared to be shocked or surprised. For example, Disney, they went 25 years in a row without cutting their dividend. And then this whole pandemic happened, and they, for the first time ever, had to suspend their dividend for the next quarter. And this is Disney, one of the biggest companies in the world. All right. Another thing they're always doing is working to improve their game. All right, because the markets change. Even if you're great one year, it doesn't mean you're going to be great the next year, because the markets change. The people that come into the markets change. So you have to adapt. You have to find new technologies, find new ideas, see what's trending, see what's not trending, and always try to be ahead of the game. You do this by finding correlations and hedging. If a certain sector does bad this time of year, maybe sell it. You got to be ahead of that. There's always patterns. You just got to find those patterns. And for a long time, they've been consistent. Like air transportation, the aerospace, they have like a 7-year run where they go high, and then they have 7 years where they drop, and it's pretty consistent. And be fluid, don't be attached to one idea. Be humble, be willing to change. Be like Bruce Lee said, be like water. So any final thoughts or questions that you all may have? It doesn't have to be specifically to this. We have 8 minutes and 28 seconds left. So please, take full advantage of it. Ryan, I know there's a lot of stuff that's confusing you. Share, man.
So I've learned a whole lot, mostly from like yourself, Juan, Alex, like he's talking about. I think whenever I jumped in this, I was in the same boat that Juan was, and it was more of I'm just following the crowd and trying to figure this out, and it was a lot of penny stock stuff that everybody was amping up. And I think that luckily I didn't invest too much into it, and I just kind of played it safe the whole time because I really just had no idea about it. And I wish that, in my younger days, like some of these guys that are watching right now, that I had somebody like you that would take the time and actually talk to us about this. And so for that, I thank you. And these guys, I hope that you take it seriously. But like questions that I have is for example, with this company called IVR, which is like Invesco Mortgage Capital.
Yep.
Are you familiar with them?
Yeah.
So with them, I want to say that they have like a 34% dividend. Like, how does the dividend work? Is it like a quarterly thing to where, is it per share, or like, I'm still trying to figure that piece out.
So they'll always post it, right? What they post is on a yearly basis. So you have to see the company, because there's companies that pay a dividend on a monthly basis. So that number, that figure you see, that dollar value you see, will get split by 12 for each share. So in order to get the full value every month, you would need 12 shares. There are some companies that they do it quarterly. So mostly the big companies, Apple, Disney, Coca-Cola, they'll pay you every 3 months. So those numbers you see posted are you have to divide them by 4, because that number, if they say $1, that's their dividend. That's going to be 25 cents per share every quarter that they're going to pay you. So in a year's time, it'll be $1. So in order to get the full measure of that, you have to have 4 shares for a quarterly stock. There's not many that do semi-annual, like every 6 months, but it's all public record. You could even go see their dividend history. So you could look at Invesco Mortgage Trust and go and see Invesco Mortgage Trust history, and you'll see like all their dividends. Was there times that they didn't pay dividends, things like that. What I look for in dividends is to make more than I would in a bank account. So I try to look more for anything higher than like 8%, it's risky. There's a reason it's that high. A lot of real estate investment trusts, theirs is higher because by law, 90% of the profit they make has to be paid out to their shareholders. So real estate investment trusts always have higher dividends. But keep in mind, you have to know there's different types of dividends as well. So like a real estate investment trust dividend is taxed as normal income. It's not taxed at the regular investor rate. So it's just something you need to know. Like, but if you had Apple or Microsoft, their dividends are a little bit lower. They're less than 3%, but those would be taxed at a regular investor rate, which is less than your average income rate. And when I'm talking too fast, please slow me down.
It's good. Yeah.
Yeah. So anytime you go over 8%, and it's not a real estate investment trust, there's a reason for it. A lot of the fuel stocks, they have really high dividend payments, and I'm not talking about the fuel cell. I don't know much about that company. I'm talking about like BP, ExxonMobil, Chevron. But if you go look at their dividend history, I mean, the stock history, like BP is all over the map. It's all up and down for the last 20 years. It's not consistently going up like other stocks. So their way of keeping shareholders invested in their company is by paying them these high dividend money. So the investors in them, they don't really care that their stock is going to go up and down and fluctuate up and down, because they're getting that 8%, 10%, 12% dividend that they pay. Another thing with dividends is that it's not for sure. It's not a for certain thing. Nobody by law makes anybody pay these dividends. So did I lose anybody? All right. So nobody makes them pay dividends. So for example, when this whole pandemic happened, a lot of companies had to suspend their dividend, like Disney, and the shareholders can't say anything about it. Luckily, if you invested at the right price for Disney, it doesn't even bother you, because you've made money from it. So there's stocks where you could do both. Like if you came in at the March lows, or even now, like if you've jumped into to Disney around $1.05, $1.07, you're $10 up per share, and they pay a dividend. They didn't cancel it forever. They're going to pay a dividend again in the future. But there's companies called the dividend aristocrats. And this is a list of companies that for the last 25 years, they've not only paid you a dividend, but they've increased their dividend. And most of these companies you can name, like Coca-Cola, Pepsi, McDonald's. It's usually these big companies who don't have a lot of growth potential, but this is the way they keep people invested in them, by giving them money back. There's companies that may never pay a dividend because they take their money and they invest it back into their company through research and development. Like, Tesla, Facebook, Google, these companies, they don't pay a dividend because they feel they're paying their shareholders by either reinvesting in research, or by going and taking that money, that free cash flow they have, and going and purchasing another company. And they feel by doing that, they're bringing more money, more bang for the buck to their shareholders. So companies like Facebook and Google, they're always buying other companies, like other small companies, in order to grow. As those small companies grow, they're growing more. kind of like Galactus, you know, going and swallowing planets, that concept. Does that answer your question about dividends?
It does. I appreciate it.
No problem. We have 1 minute and 15 seconds left.
I actually got one more question if you can answer that. What's some advice? What's like the best advice you can give somebody that's like new into this, besides the advice I've heard from everyone is do your research?
I say pick at least a group of 10 stocks. It depends on your philosophy. If you're a short-term investor, then maybe the penny stocks will work for you because it's like the slot machine. You know, you want to get in and get out if it's a gamble. If you want to be in it for the long term, and I say long term anywhere more than 5 years and above, then pick a list of 5 sectors, and in those sectors, pick 2 stocks from each sector, and you know, do your research on those, and before you pay any dollar, discuss it with us. You know, we could, the best thing we could do is feed off each other. You know, we could tell you why it's a bad idea. We could tell you why it's a good idea. Because you may think it's great, but then you didn't think of something, you know. And I'm always that voice that is like the negative Nancy. So I'm always giving the reason why not to do it. And, you know, that's what I bring to the table. But